In 1961, a 12-year-old kid named Ray tripled his $300 investment in Northeast Airlines when the airline merged with another company. By the time he reached high school, the kid had amassed an investment portfolio worth several $1,000s, more than any of his friends could even dream of. So how is it possible, and how can you make this happen for yourself? Well guys, in today's video, we will be talking about a brief look at top 15 financial advice from Ray Dalio. Without further ado, let's begin. Think for yourself, but don't ignore the inputs from others. To make money in the markets, one needs to be an independent thinker who bets against the consensus and is right. That's because the consensus view is baked into the price. One is inevitably going to be painfully wrong a lot, so knowing how to do that well is critical to one's success. My painful mistakes shifted me from having a perspective of "I know I'm right" to having one of "How do I know if I am right?" They gave me the humility I need to balance my audacity. A different perspective on goals. It is senseless to have making money as your goal, as money has no intrinsic value. Its value comes from what it can buy, and it can't buy everything. It's smarter to start with what you really want, which are your real goals, and then work back from what you need to attain them. When thinking about the things you really want, it pays to think of their relative values so you weigh them properly. Knowing when not to bet is as important as knowing what bets are probably worth making. You can significantly improve your track record if you only make the bets that you are most confident will pay off. The best choices are the ones that have more pros than cons, not those that don't have any cons at all. Raising the probability of being right is valuable, no matter what your probability of being right already is. Be an imperfectionist. The 80-20 rule states that you get 80% of the value out of something from 20% of the information or effort. It is also quite possible that you are likely to exert 80% of your effort, getting the final 20% of value. Understanding this rule saves you from getting bogged down in unnecessary detail once you have gotten most of the learning you need to make a good decision. Write it down. Experience taught me how valuable it is to reflect on and write down my decision-making criteria whenever I made a decision. Everyone has weaknesses, and they are generally revealed in the patterns of mistakes they make. The fastest path to success starts with knowing what your weaknesses are and staring hard at them. Start by writing down your mistakes and connecting the dots between them. A take on diversification. Nobel Prize-winning economist Harry Markowitz had invented a widely used model that allowed you to input a set of assets along with their expected return, risks, and correlations and determine an optimal mix of those assets in a portfolio. I asked my math major in my firm to do a chart showing how the volatility of a portfolio would decline and its quality, measured by the amount of return relative to risk, would improve if I incrementally added investments with different correlations. Failure comes with the territory. People typically feel bad about their mistakes because they are short-sighted about bad outcomes and not about the evolutionary process of which mistakes are an integral part. Every mistake that you make and learn from will save you from thousands of similar future mistakes. Everyone fails. Anyone you see succeeding is only succeeding at the things you're paying attention to. I guarantee they are also failing at lots of other things. The people I respect most are those who fail well. I respect them even more than those who succeed. Dalio on Bitcoin. Ray Dalio, who has generated more than $46 billion for investors since inception, claims that cryptocurrency have the potential to fulfill the need for alternative investments. While he was among the big critics of Bitcoin and the digital currency phenomenon in the past, he now owns Bitcoin and expects it to become a true store of value. Know your asset values. If my business has a net profit of $50,000 and a multiplier of 4, average multiplier in the web service industry, it is now worth $200,000. That's how much I can potentially sell for. The industry multiplier is one of the main reasons Silicon Valley startups get bought for tens of millions of dollars while barely making any money. They use very high multipliers. If I want to keep my business, I can borrow more liquidity than when it was worth $0. Be cautious about debt. Sometimes, a debt like buying a house, an apartment, or an office for your company produces forced savings, which is a good thing. Whether the real estate market goes up or down, you won't lose the money as long as you don't sell, so this asset contributes to your net worth or the one of your business. If you or your business need to create a debt in order to acquire an asset, that asset should produce more income than the cost of your debt over time. Learn how to save well. Almost nobody becomes financially independent by saving 10% or even 20% of their income for their whole life and investing it in low-risk, low-cost index funds like the S&P 500. The truth is, life gets in the way. You probably have a house to pay, a family to raise, and if you're an entrepreneur, even a business to run. Saving is not the key to riches, but it doesn't mean you shouldn't consider it in your financial strategy. Do the opposite of what the crowd says. Market timing is an extremely difficult game to play because it relies on emotions and sentiment, two things human beings are very bad at controlling. The only way to win is by having access to a lot of resources most people can't afford. Dalio and his team spend hundreds of millions each year. That's why most day traders go broke. Regardless, Ray Dalio's advice of going against the flow is still very relevant for entrepreneurs. Be aware of the wealth gap. Whether you're just starting off as an entrepreneur or you're the CEO of an established business, understanding the larger socioeconomic context around you is crucial. This creates a dramatic wealth gap that is not sustainable in the long term. Economic and political systems are based on the notion of compromise and bringing people together, and right now, these systems are doing the opposite. Transcript. Ray Dalio. I'm Ray Dalio. I'm a global macro investor. I have done that for about 50 years in all liquid markets in the world, and the world is changing. And I learned it by having surprises in my lifetime, that many of the things that surprised me didn't happen in my lifetime before, but happened many times in history. And these three things that are now happening are the creation of enormous amounts of debt, the monetization of that, which is having its effects inflation, and all. The second is the amounts of internal conflicts that are going on, populism of the left and populism of the right due to the largest wealth gaps and value gaps. So guys, let me know your thoughts down in the comment section below. For more interesting content, give this video a thumbs up and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I will see you in the next video!